This is the Beyond Return Show, a forum about business, markets, financial planning, and more. And we are here with Montebello Avenue's founder, Robinson Crawford. Robinson is a certified financial planner who serves clients locally and throughout the country. Robinson is from Phoenix, Arizona. My name is Gabriel Kaplan, and I'm the founder of Wealth Habits and Strategic Investors. I'm a financial advisor, and I help people invest and manage portfolios for them. Given my background as a CPA, I also help people figure out strategies to optimize taxes, which is pretty relevant right now. The agenda for today, we're going to talk about dividends, what they are, and the key concepts of what you should know. We're going to talk about market cap weights for index funds, which is an important feature of any index fund, and what you should really understand about them. And then we're going to talk about profit pools in an industry and some timely matters of this week. I'm happy to start off here with the dividends. It's usually companies that generate excess cash flow and they want to return money to shareholders. And there's two ways of distributing money. Usually it's stock buybacks and dividends. The dividends usually come in many flavors, but the majority of them pay in cash.
Start at a really high level here, because dividends, I find that is something that people get excited about when they first learn about. So if you don't know what a dividend is and then you figure out what it is, tell me where I'm wrong in this logic. I go buy a company, I open my Robinhood app, I grab a share of Disney. They pay dividends, right? And then I
will say that Disney, I think, pays dividends for now. But there's an activist investor there that has said in the past that they should suspend the dividends while there's a pandemic going on, and they should derive all that cash flow to pay for buying up or investing in the streaming service, because that would create more value.
Interesting. Okay. So I go buy a stock, I hold it. They pay me just to own it. They're going to pay me in cash a little bit of money just to own the stock, right? Is there anything wrong with that very simplistic assumption about dividends?
Technically not. In all aspects, they pay you it's not for the reason that you own it. It's more of the company has excess cash flow, and they have decided that the best way forward of using that cash flow is just to give it back to the shareholders, because they cannot reinvest it at a very high rate. So they thought maybe investors can reinvest that money at a higher internal rate of return. So then that's what they decide to do.
I also would add that it's simply a way for management to keep shareholders happy, right? That's pretty much what you just said, right?
Yeah, essentially. Well, management technically works for the shareholders. It's not apparent all the time,
right?
But they're supposed to work for shareholders, and they report to the board, which is essentially elected by shareholders.
Right.
Now we can go into tangent here and say that not all shareholders have equal rights in many companies, specifically the tech companies. Like I think Facebook's founder Zuckerberg has, and probably doesn't own as much as a percentage of the company he doesn't own, but the voting power he has is enormous. Same with Elon Musk. There's a lot of these happening at Snapchat. I think Google as well. There's many, and you can see it because there's many classes of shareholders. I think Google has 3 classes, A, B, C. I think the ticker for the voting share class is GOOGL, and the non-voting share class of Google is GOOG. And then there's like the founder share class, which isn't even traded. The founders have it, and the moment they sell the stock, I think it gets converted automatically to a voting class. They give employees the non-voting share class. So like I think they give them the incentive stock that they give them, like the RSUs. I like to see companies that just have one share class, because it allows activist investors to come in and demand changes that are beneficial for shareholders.
Dividend payouts can be on a schedule that the company sets, basically. In addition to that, so those are for regular dividends. And of course, companies are going to signal when, hey, we're planning to pay a 10 cent per share dividend for the foreseeable future and we think that's financially viable, they communicate that to shareholders, right? But in addition to that, you can also have special dividends, which are one time, maybe chunkier, or in response to a specific transaction or some sort of money making activity where the company says, "Yeah, we've all of a sudden for a non recurring reason have more cash on hand than usual. We're declaring a special dividend."
Yeah, it's a very interesting case of special dividends. There was one that happened with Microsoft in I don't remember exactly when. It was like 2001, 2, or something like that, where they had the ability to repatriate all their um, cash from globally at a very low rate because there were some tax things that incentives that to repatriate money. Um, and what they did right after they repatriated money was they paid a massive dividend. And that dividend really screwed up the economic statistics of the United States. So if you look at income statistics for the United States, you will see like a little surge. And
Was it because of the dividend or the repatriation?
so they repatriated a lot of money, and I'm not sure if they did a combo of buybacks and dividends, but they definitely did pay a dividend, and that dividend was noticed in like the income statistics of the United States. There was like a massive spike there. The other thing that I think are very is kind of interesting is have you heard of the automatic dividend reinvestment plans, DRIPs?
What is it? What's a drip? What's a dividend reinvestment program?
Many companies have what's called DRIP plans, or I guess drips. And what they allow is they allow you to reinvest your dividend and buy the stock with the dividend. So you're not getting the cash, right? You still have to pay taxes on it, right? Because it was a cash outlay, but you're continuously reinvesting in the company. So you don't have to go in every quarter and like, buy issue some transactions and buy it. It just does it for you at market prices. And so if this is someone who is looking to just reinvest their money and they're in the indexes and they don't really care so much about rebalancing at the moment, they just want to have all the cash allocated consistently. Like they don't have to go in every quarter, every month to do this. That's a good person for to sign up for drip plans for each individual index, right? So the brokers will allow you, some brokers will tell you like, oh, you can only whatever each stock pays in dividends, you have to reinvest in that same stock. Some of them will say no, you have some flexibility here where wherever dividend gets paid, you can invest in one specific stock, so you can concentrate all the dividends into one specific stock, and that it gives you some flexibility there. Companies in the old days when you had to like when you could technically buy the stock directly from a company and keep it under your name and not under the broker's name, um, then there was drip plans. That's the origin, I think, of those plans, right? They come from the company where the company would pay you the dividend, send you a check, every quarter for the amount of stock you held. But instead of doing that, they just increased the amount of shares that you would have in the company.
Yeah, that's the old way. There's an in between way that I've become familiar with, which is I've seen a brokerage called Computer Share, and Computer Share has functioned as like the house broker for certain companies. So I've seen clients who inherited stock from their parents, for example, of like a local utility company. It used to be held at the company directly, and then Computer Share became the broker of record, and they've been doing a drip since 1964. That would have been a lot of cash that would have accumulated by that time, but having
Yeah.
that all reinvested can be, well, depending on company performance, can be really valuable or not.
There's two things more I want to talk about this and then move on. But the first one is dividend yield, and then the other one is payout ratio. I think those two are the two big concepts we should talk about in terms of numerical, how to analyze this stuff. So dividend yield, what is dividend yield? How do you calculate that?
Dividend yield is the dividend per share divided by the share value, right? So if you've
Yeah.
got a 5 cent declared dividend that you expect to happen once a year, and then you've got the stock that's worth $1, 5 cents over a dollar is 5%. That's your dividend yield.
So if a company pays four dividends, dividend payments a year, you would sum up those four and divide it by the price. That's kind of like, it's usually, I think it's the dividend that they pay out over the course of a year, right?
Mm-hmm. Should be
Right. So
annualized.
yeah. So if companies pay one dividend payment a year, then it's that payment over the share price. If it's four payments, you take the last four, and you multiply them, or you divide them by the share price, and you get that in the percentage terms. That would be the dividend yield, and people use that to compare stocks, to see which one pays more dividends. But it's not always accurate to compare dividend yield against companies, because some companies, out of their cash flow, pay a higher percentage of that in dividends, versus other companies are still growing and reinvesting a little bit. They might pay a lower percentage of their cash flow in dividends, right? So I think that's the payout ratio. How much of their cash flow, is being paid out as dividends? And so having those two pieces of information is actually really important to make any sort of comparison.
Agreed. Now, would you choose to use actual cash flow? And there's a few ways of calculating cash flow. I don't want to get too wonky with accounting. Or would you use something like net income available for this payout ratio? So the payout ratio is how much dividends are they paying compared to how much cash flow or how much net income do they have? Do you have a preference on measuring that?
So I think the standard way of analyzing is right. You're right. Like, it's total dividends over net income, right? I think the traditional way. Net income is a little bit wonky. You can manage
Manipulate
it,
it.
right? So I
Yeah.
prefer to use some sort of cash flow. What percentage of the cash flow that the company generates is being paid out, and adjusted for taxes and everything, right? But like, what percentage is actually used to pay out, for dividends? The one final thing I forgot about this is to mention, like, you can't just buy a stock right before they pay the dividend, right? Like, that's not possible, right? Don't they have this? They have this thing called
Ex dividend
ex
date.
dividend and record date, right? So like,
Mm-hmm.
the record date is the date that you officially become, part of the books of the company as a shareholder.
Yes. So it phrased differently, you can't be a day trader with high turnover, jumping in and out, and just jump in right in time to get the dividend and then jump out and expect that to be a value creating exercise, right? That should not, all things equal, that's not supposed to work. Markets are too efficient, too sharp for that. I got a little, one last thing on dividends. I got a little dividend story for you. I made a bet with a friend this year who works for Shell Oil. Shell famously had not cut its dividend, had not reduced, and had not stopped paying its dividend since World War II.
Wow.
In March of this year, you'll remember there was some market turmoil. Things were looking bad. Things were looking especially bad in the energy sector because consumption.
Didn't price of oil go negative?
Price of oil went negative. I think that was maybe April. I think
April.
I think this discussion was before oil technically went negative, but I'm not sure. But I made a bet with a buddy who's a Shell employee. I said Shell is going to cut their dividend for the first time since World War II in 2020. He said, no way. We don't do that, right? As a matter
Yeah.
of who we are, that's our identity. We don't cut the dividend. I said the financial stress is going to be too big. You're going to have to do it. And I think it was June or July that I sent him the screenshot of the news article that Shell had cut its dividend dramatically because they were paying, they were scheduled to pay because their share price had gone down so much, something like 14 or 16% of their share price as a dividend, right? Which is just a huge cost to the company when you measure it against free cash flow or net income.
If there's a lesson to be learned here, is if you're engaging in any strategy that involves dividend investing, if you're focused on the dividends, just make sure that the company is going to be able to pay it in the long term.
I wanted to talk briefly about index funds and market cap weighting. So many people are invested in index funds or index fund like strategies in a lot of ways. In your 401k, they're very common. If you own a target date fund, You're going to have index fund like strategies in there. And then lots of people seek them out as low cost and practical investments, which I think they are. Um, the main feature of most index funds is that they do something called market cap weighting.
Yeah.
Market cap weighting is the most kind of academically popular and construction wise popular way to construct an index and to measure an index as well. So most people are tracking when they say, oh, the S&P 500 is up or down today. The S&P 500, for example, the 500 stocks inside of it are weighted by market cap, meaning the biggest companies with the most equity outstanding have the largest positions inside the index fund, right? This is really important to understand because index funds, when you think about the concept, you might think, oh, I own every stock, I own the total stock market. I might own, the same amount of every stock. And that's not at all the case. You own much more Apple than you do Hershey's, for example.
One thing which is, I think, really important is that index funds, they call them passive per se. When people call passive funds, they passive technically is just a subset of a certain index. Market weight index is a subset of passive funds. Passive funds are any fund that is not actively managed, but you could technically have rules that denote some sort of passive fund. So essentially, you could have a say like, oh, this passive fund will invest in a formula that is focused on momentum, right? Is that an index weight fund? No. On the market weight, the traditional market cap weight, no. There's a formula for that, but it's not the traditional one. This traditional index fund by market cap is something that, although we call passive, in my opinion, it's not 100% passive. But it's a totally different tangent that I'm going here. But it's like one of my pet peeves is like when somebody says, "Oh, I'm invested, I'm totally passive." Like, so, okay, great. What do you invest in? Oh, I'm invested in market cap, the S&P 500 index. First of all, the S&P 500 index is the organization that controls that is like a board that decides which stocks to go in.
They have
And they have a couple
meetings.
of
They're
rules.
active. They're
Yeah.
doing work.
They're doing work, right? So,
Yeah.
Tesla, which is a good example, wasn't included until this year? And they're a $500 billion company, and they're what percentage are they worth now in S&P 500?
It's something like 2% of the S&P index.
But it's incredible. How do you go from 0 to 2% if you're market cap weighted? That's not really like market cap weighted. You have other rules there that will dictate whether you're included or not.
Totally.
And I think what the rule that really dinged them was 4 quarters of profitability. But companies like Tesla are going to be unprofitable until they reach certain scale, and the stock will go up until they reach that scale. So technically speaking, now that they've included them, I feel like a lot of the percentage increase of value the S&P 500 has missed out. So if they were true market cap weighted, they wouldn't have missed out a large portion of those like the performance. But as this kind of activist, I would say,
approach to market cap weighting,
a market, has hurt the
it's active,
the owners.
it's active passive to be an S&P 500 investor. Yeah.
The other portion of that bothers me about a little bit about the concept of people saying, "Oh, I'm a passive investor. I invest in like market cap weightings," is that no, you're not passive. You're taking an approach saying, "I will buy the companies that are the biggest market cap weightings." It's an active decision to take. Why not buy equal weight, right? What's the difference, right? No, you're taking a position that companies that are bigger are better.
And that brings me to a good example. You mentioned Tesla right here. I think we said earlier that Tesla is now the 6th biggest company in the S&P 500 today. They are right in front of, last time I checked, Berkshire Hathaway, which is kind of a nice little juxtaposition, right?
Totally different company.
Totally different company. Berkshire is a conglomerate, mostly an industrial company, factories, capital intensive, making insurance, a lot of old world stuff, right? And it's run by the deity of value investing, Warren Buffett, and his accolades, right? So they have a very specific approach to how they're going to deploy capital, what they're going to use it for, what their vision of the world is, right? As I'm showing here on my screen, Tesla is a $617 billion market cap. Berkshire Hathaway, $529 billion. So Tesla is going to have a larger weight in the S&P 500 or in another market cap weighted index today than Berkshire Hathaway, but they're going to be pretty close to each other in terms of allocation inside of an index fund, right? So if you're
Yeah.
owning an index fund, you're going to own a good bit of the companies that are larger than these, which is only 5 of them, and then pretty close to equal weight between Tesla and Berkshire Hathaway, which I think that's a good thing. I think that's a testament to diversification and not having all your eggs in one basket. Tesla is, of course, very exciting. I know Tesla is dominating the options markets. It's some huge percentage of options volume is now just focused just on Tesla.
One question I have about the market weight, they usually meet every quarter, right? The big ones meet every quarter, I think, the committees that decide which companies to include. But they more or less follow a formula, right? Which is the market cap and certain other things which they disclose. So my question is, how much can you front run one of those market cap inclusions?
Every once in a while, I find myself clicking on and reading a public hedge fund newsletter where they'll write their quarterly report and they'll say, okay, we own all these stocks and this is our outlook for it. I've seen inclusion in Russell 2000 or inclusion in Russell 3000 as a catalyst for many investors who think that will be an upside surprise for a particular small stock. So I think it is a reasonable thing to assume.
Have you looked at the S&P 500, the SPY, the ETF, the Spider ETF, which is I think the biggest ETF out there that is invested in the S&P 500, right? I don't know what
I think it is.
Yeah, so if you look at it, the year-to-date flows, though, have been negative, which is surprising to me.
That's interesting. I wouldn't have guessed that. I think a
Yeah.
lot of when people start to focus, if you're an index investor and you want to be a market cap weighted index investor, I think you'll find a lot of industry participants would tell you to shy away from specifically being an S&P 500 investor for the exact reasons we've talked about. It's run by committee. It's not a true kind of robotic market cap weighted index. You can buy a total stock market index, which there's tons of companies that offer them. BlackRock, Fidelity, Vanguard all offer
The Vanguard one, the total market, or total U.S. market at least, is it just crossed like the 1 trillion.
I saw that. That's the mutual fund.
Yeah, same with the total international bond ETF by Vanguard. Also, it's year to date, the flows are positive. It's just very weird to me to see the index funds, the equity index funds, to go down. And instead, you have these. Have you heard of the ARK Innovation ETF? Those ones have had tremendous inflows. As a percentage of their assets, it's huge. And I think it's just one piece of that puzzle where I have a feeling that we're entering the stage of euphoria around a certain subsector of stocks, which is like the SaaS companies, the tech, and all that other stuff, the growth stocks.
If you're buying an index, know what's inside of it, know how it's constructed, know if you're subject to some committee approval. If you owned the S&P 500 instead of the total stock market index this year, you probably missed out on Tesla's performance in the market, which was a shame, honestly, that you were waiting on some committee to do that.
If you're investing in the consumer discretionary subsector, right? So there's a spider called XLY, and the holdings of that is a little bit alarming, right? So the top holding of the consumer discretionary select spider, they have 61 stocks there, so they're just like I would guess it's more of the S&P 500, but kind of the companies that are it's large cap growth, right? But they're more focused on just the consumer discretionary. So the holdings in there is what scares me. It's like Amazon is 21% of that ETF. Home Depot is almost 11, and Nike is 7. So if you come, and McDonald's is 5, is almost 6, and Starbucks is almost 5. You put like those ones together, and enormous amount of almost, I think it's almost like 50% of the companies are the first 5 stocks. So do you get diversification there? I don't think so.
Yeah.
Like
Hard to say.
ETFs, you're supposed to get diversification, but not all of them have it. So you have to
That's
be
right.
very, very careful. Good. So let's move on to the next topic, which is profit pools. This is one of my favorite kind of topics, is to discuss um, when you're evaluating an industry. And I'm going to put an example, like a coffee industry. There's various participants in the coffee industry, from sourcing all the way to the coffee shop and the drink you're drinking, right? So you have farm production, you have traders, exporters, you then have processing, then you have maybe a retailer or wholesaler, and then at the end you have a coffee shop. And then parallelly, you have on all of these areas, you have machinery, right? Commercial machinery, which is for the coffee shop, but also you have industrial machinery for the processing and the farm production. And so each piece of this pie, I would say, or the process, has different types of economics. And it is important to note that if there's a trend like the electrification of the auto sector, or if there is a trend such as, the distributed computing, or whatever you want to call it, you can't just invest blindly in the industry, right? It's much better to just go in there and like evaluate company by company or sector by sector to see what are the inputs in the sector and or subsector. Like, so let's say coffee shops, right? What's the input? It's the coffee and labor and real estate. And what's the output? It's consumer appetite for Starbucks, for example, which is one of the major players. So at the end of the day, there you have a unit economics of that business that kind of is very similar across the different competitors that Starbucks has. So now Starbucks is a giant in there, and they will have they're working at scale, so they have very good economics. But at the end of the day, um, these different companies will have different returns of capital, and they will perform very differently over time. And I think it's really important for an investor, specifically if you're an active investor, to understand that if there's a trend, not everybody will benefit the same. And that is the key thing. And there's some interesting academic research that I'm hopefully going to post links to at the bottom of the description. And again, like, not all actors in the value chain will get the same slice of the pie. That's very clear. Um,
That was the phrase I was hoping to hear you say. That the way I've heard this referred to before is the value chain, right? So the value chain of a coffee shop, like you talked about, the value chain of an Apple computer, and that's why the piece we talked about a few weeks ago of Apple now manufacturing or designing or whatever they're doing specifically with the chips is a really important part of the value chain, and that's why that news really matters for Apple stock and their outlook for the future. Is if they're able to capture a higher return on capital part of the value chain, that really changes the economics of what this looks like moving forward. And of course, equity markets are always looking forward. So when you're thinking about an industry or when you're looking at investments, are you always making sure to do homework on the value chain, try to see who's capturing what, and
If I'm looking at a specific company, or even like a subsector of an industry, to invest like in a specific ETF, maybe that targets a subsector of an industry, I will look at the value chain, where they are. And a big starting point is Michael Porter's five forces. It's not perfect, but it kind of starts to give you a framework of how to value that, right? So you want to figure out the bargaining power of each one of the both the supplier of their products and the buyer, right? So if you think about it, this is a really interesting one that's happening right now. It's all insurance. Just like, how many insurance companies do we have in the United States right now? Big ones. We have a very few of them. Yeah, and those are the ones who pay the hospitals, right? They pay the hospitals. So they have merged and created huge power, have huge power. They've really forced all the hospitals to kind of like merge together, and they've killed the smaller kind of independent practices. Right? So they've forced the buyers of or the ones who use that insurance. They force it's like an arms race, right? Like who gets bigger and who has more power. Like can you survive? Can the insurance company survive without like the only hospital system in the city? No. Like that insurance needs to be on like needs to work with them. If you have kinds of fragmented hospitals, the insurance company will have enormous amount of power. They could just say like we don't want to work with you if you don't submit to our demands. And that's kind of like it's like an ongoing war where at some point I think the federal government is going to have to step in and say like this has to stop. This you can't continue to merge because
To
otherwise,
dominate. Yeah.
yeah, it just has market dominance. So those are like the two and there could be a company in the middle there that sits between very two powerful kind of you know suppliers are really powerful and buyers are really powerful. Well, they have no leverage and they're going to die, right? Or not.
Or
They have to merge with some other
have
companies.
thin margins forever, right?
Yeah. And then you have how easy. One of the other things you have to look at is like how easy is it to start a company and start competing with them. And the easier it is, the, the more difficult it will become, to you know to become successful, to get outsized returns of your invested capital. And one example is that for me is like the producers of oil, right? You have shale oil that, give it or not, it doesn't take a ton of capital to just start a shale oil company or like just an oil producer to be, when you sell to whoever's on the market. Um, and whenever the price goes up a little bit, you see like the amount of rigs they spike and everybody starts producing, and so you're going to always have that like threat of new competitors coming in because of the share, the price of oil went up a little bit, and so you'll have a ton of people coming in and so supplying the market with the product. So if you have that, then um, it's going to be really tough. Big thing is also like the threat of substitute products, right? So a clear example that everybody uses in academia is like if you're in New York, you want to go to Boston, you can take the train, the car, or an airplane, right? Obviously, you have different markets for everyone. Like consultants and will use airplane all the time, but if you're a student, you're very sensitive to price. So like if the price is the same, I'll take the plane, right?
Mm-hmm.
But if the price is slightly higher for the plane, I'll just take the train or the bus.
Mm-hmm.
The bus will always usually be cheaper. So another competitive force or like another force that's in there is called networking effects. And that wasn't like it's not a box itself in the Michael Porter strategy. Um, um, the way he describes uh, his original thoughts on um, the
Competitive
strategic
forces.
framework, yeah, but network effects is something that's huge in the new economy. Right, Facebook has it, Google has it. It's like the winner takes all. Netflix, like you have one of them to rule them all. If you have that kind of situation, it's very powerful. And then the other one is switching costs.
In addition to all of what we just talked about, this competitive forces analysis of a specific industry, subsector, or whatever it is, companies can also have high return on invested capital and their stock cannot perform well. That's not
That's
at all.
yeah,
That can absolutely happen.
yeah,
And in wonky markets, that absolutely does happen. So,
yeah.
buyer beware. You can do a ton of really good, excellent homework, get it right, and still not have it pay off in terms of stock performance.
And the reason why it's very simple to me. Like there's two other factors that you have to look, which is eventual like growth, right? You want to buy companies that are growing, right? That are able to grow in the future, right? So that's one aspect, and then you have to integrate in your analysis also the valuation aspect. Like if you're paying huge premium for a company that's growing healthy and has a very high return on capital, you might have paid too high of a premium to warrant, to justify that price. And as a result, the market will eventually, as the premium of the stock goes down over time, that means that even though there was growth in earnings and growth in everything, still like the multiple that you pay for it is going to compress over time, and that's going to kind of dampen the return you would get in normal circumstances.
Link something to Michael Mabison's Expectations Investing for this show. That's a great read on gauging the market's expectations for a company's performance and how to discount that against your own.
Can you give a little bit of a background of that?
Yeah, of course. Expectations investing is taking a stock's the numbers of how they're performing now, their stock price, their expected growth, and baking in the market's kind of median expectation for how they're going to perform. So all things equal, a highly priced company relative to its sales and its growth is going to have high expectations built in.
And if they don't meet that, what happens?
Then that's bad for the stock price. And you paid a premium for something that may not perform at a premium. The opposite side of that is something that's trading very cheaply, has low embedded expectations. So whenever you're buying a stock, you're buying from someone else who has, you can assume the same set of numbers in front of them as you have. Expectations investing is about playing everyone else's expectations.
And that's all what we had. Just one thing that's very important here is like anything that's said here in the show is for educational, informational purposes only. And like even the stocks that we mentioned or ETFs, they're only here for educational components or educational purposes. Any specific tax, financial, legal, or investment takeaways that you had, you must consult it with your own accountant, attorney, advisor. Definitely do that before you act on anything you heard from here. We are not your advisor.
Agreed.
Feel free to call us though.
Anytime.